An investing guide, it's all a risk too. Chapter 1. Investing Myths and Rules. Investing Myths. There are hundreds if not more investing myths, stories, and conventional wisdom regarding what works in making money in stocks, bonds and funds. Obviously all can't work because some contradict each other. Some may work some of the time, but no one theory as far as I know works all the time, because if it did, everybody would use it, then it would fail because of saturation. The bottom line is that nobody can predict where the market and masse will go in the future or where a company will go in the future. Past performance is not necessarily a good indicator of what will happen in the future, especially in these fast-changing times. It's good to have guiding principles when investing, but don't rely on any theory or idea too much, because all will fall short over time. There's always an X factor involved. Greed destroys just about everyone who falls victim to it. There is no such thing as an infallible expert on Wall Street. Everybody picks turkeys. Don't listen to anyone with a personal stake in the stocks they recommend. Look for unbiased journalists who just write about it but don't own any of it and don't work for an investment firm. Comparing stocks in 20-year periods to the money earned in a regular savings account, stocks don't always come out ahead. You have to buy during a bear, wait for the bull, then the hype of the bull, get out, then wait for the end of the bear, and repeat the cycle. Most stocks take a long time to grow and many lose money. Are they really as good as people say they are? Stock momentum that goes up can go down very quickly. Experts contradict each other. Most have a hidden agenda of pushing stocks they're allied to. Stocks with low price-earnings ratios are not necessarily growth stocks or undervalued. Do more research before you buy a low P/E ratio stock. Stocks with high dividends are not necessarily safe. The stock can drop anytime. If you want to be safe, invest in bonds instead. To some people, undervalued stocks trading at below book value are a good deal because they represent the hard assets the company is holding, but to others, it's undervalued because it has no potential, that's all it's worth. Book value is often just a function of creative accounting. It doesn't necessarily correlate with the real value of the company. Any company or industry can have a downturn anytime. Big conglomerates often appear stable because of fancy accounting. In actual fact, their different holdings are always going up and down, balancing each other out. Companies with stable earnings could be dull companies that aren't growing and could go down if something in the industry changes or they don't change with the times. A great company is a well-managed company, not just one that looks good on paper, but even with a well-run company, the price of the stock might be too high to be profitable. Most good companies start off strong but sooner or later become average like all the others in their field. All great products are copied then lose their edge. Great companies constantly come out with new products that customers want. Growth stocks can either grow or melt away. Nobody really knows the future. Look at all the bubbles that burst in the history of the stock market. Some once good companies going through a bad time recover, some don't. Contrarian investing is going against the crowd, doing the opposite of what it does. They buy stocks currently down because they think the market is overreacting. This is generally true, but you have to have patience and a great tolerance for risk to buy a stock when it's down, because some will stay down. When companies are initially acquired, the stock value jumps, but over time, because they are not the company's bread and butter, they usually take a beating as lower-level stocks. If the hype sounds too good to be true, it probably is. There is rarely easy money in the stock market. If it is and people know about it, they will greedily keep the secret to themselves and their allies. If you follow the momentum of the stock market, you will also get eaten up when the bear hits. Everybody is hoping for the hidden gem that nobody knows about, but the money managers are tracking the stocks too. It's a tough call to find the next big gem that nobody knows about yet. I see all the hype all the time in those ads companies place about themselves in magazines and newspapers like Barron's and Investor's Business Daily. Take your educated guess. It's as good as mine. Stock market trading is not rocket science. Beware of all the technobabble. Look for well-managed companies selling something that people want. Stocks involve risk. If you can't handle risk, don't invest. You will pick losers. There is no guarantee, not even in the long run. You could pick all stinkers or the entire economy could go down the tubes in the stock market sense even though the sun still comes up every day. Beware that companies often use creative accounting. Try to get a feel for the management and growth of the company and industry. Low-priced companies are priced low probably because they're not very good. All the education and training in the world will not necessarily make you rich. It still takes an element of luck. The bottom line is to look at the company over more than just a few months. The IPO period is never any good because it's like a honeymoon, full of hope. You have to look for stability over time. Golden rules of investing. 1. I look for a company that I understand, that has a durable competitive advantage. Warren Buffett. It's not that he's a great stock picker but a great stock avoider. Journalist talking about Buffett. In my opinion, the economy is abundant, it's always growing and the reason for that is twofold, there are always more people, hence more consumers and the existing people are greedy and carnal meaning they always want more consumer goods and more variety in an increasing rate so the golden rule is don't follow the herd/sheeple when the market gets bearish because it's always growing, always going up no matter what. The United States is the most popular country in the world. Every year, at least 1 million or more people come in to become new consumers who buy from the corporations on the stock exchanges. Both stocks and mutual funds follow a herd/sheeple mentality where when the buzz is in, people buy then when the value goes down, some panic, sell and the value goes even lower. Investing on Wall Street is all about emotions, namely fear and greed. Do not get emotional, stay rational. I lost money and made money like a yo-yo. That's the name of the game. Remember, it's gambling. More people lose money in stocks trying to bail out of a temporary bear downturn rather than sticking to it. Every time you make a transaction, you're paying out fees and commissions so if you haven't got much money, it all adds up so what I'm saying is don't panic. Do your research first, buy your stuff and sit on it for a while. Educate yourself so you buy a solid investment up front so that if it fades a bit, you don't panic. You're supposed to be in for the long haul. The Dow Jones Industrials make up only 30 stocks. Ignore the daily Dow Jones readings, they're largely irrelevant for most people. They do not necessarily determine the trend in the rest of the market. The Dow Jones may be going down while a bunch of other individual stocks are gaining. The sheeple effect also extends into all the crap that's constantly coming out in magazines, newsletters, the internet, and on TV. They have to fill up their journals and TV shows with something but what they talk about is usually not relevant to the long term. Single economic reports rarely have much effect on the market long term. Don't trade much. Don't switch too often because you have to pay commission fees. Buy a few stocks and sit on them for the long haul. Staying with the emotional theme, people might beat themselves up for missing an opportunity that paid off big so they will do the irrational thing and get on the next gimmick that turns out to be a dud. When it comes to investing, people are penny wise and pound foolish. Do not listen to anybody when they tell you about a hot new stock, especially if it's high-tech on the OTC board, unless you're a gambler. Many of these companies are dud companies created to con investors. Stay away from initial public offerings completely. They're often hype. With all the investment junk mail I get, I have seen hundreds. It's always the same pitch. They try to say they're going to be the next cable TV, VCR, Microsoft, Apple, etc. There are absolutely no experts in the field unless you're a psychic, and there's no such thing. When I was really into it at one time, I'd read different publications where so-called experts contradicted each other all the time, so the point is that you are your best expert. Do not pay money for so-called expert advice. Once you learn the basics and understand the market system, you're on the same level as everyone else. From then on, the key is current education, keep up on the latest corporate movements. All brokers have an agenda of trying to sell investments that they're part of, that they're either invested in or that their brokerage is underwriting, plus trying to sell simply to earn commissions, that's the bottom line. Educate yourself by checking out a few books at the library, then check out the major dailies like Investor's Business Daily, Barron's Weekly, The Wall Street Journal. Check out the money magazines, and for corporate profiles, check out the Value Line Investment Survey, Standard & Poor's Corporate Filings, Moody's Corporate Filings, Dun & Bradstreet, Walker's, Ward's, Hoover's, all at the library. Walker's Corporate Directory lists the ticker symbols of thousands of companies. Conventional wisdom says that if the major money magazines are touting a stock, forget it, the secret's out, but this is not necessarily true. Just because a major money magazine writes an article about the 6 best stocks or whatever doesn't mean that the masses of investors will go out, buy them then, because it's overpriced, its value will go down. There's an overload of information out there. Most big-time investors are plugged into the internet. I have found some true, blue great wisdom-filled articles in some of the money magazines, but you have to be able to discriminate between the true wisdom and the crap/bull/hype. Kiplinger's did an article called Biggest Winners of the Decade, which was right on based on previous knowledge that I had partially from the PBS documentary The Triumph of the Nerds and partially from my general observation of computer stocks. Every stock in that article was an incredible winner. Don't underestimate the articles in the mainstream money magazines. Everybody's not going to jump up and buy the favored stocks. There are true gems in there that are worth more than any advice you will find anywhere else, especially the crap in some of them phony, overpriced investment newsletters. General stock books are at number 332.63, and there are all kinds of corporate books at number 338.00-338.776 of the library, but they're all outdated. You have to get the current corporate filings and study them. General business resources are at number 016 at the library. If your library has both a business section and a general section, check them both out. A good book is The 100 Best Stocks to Own in America by Gene Walden, Dearborn Financial Books, 155 North Wacker Drive, Chicago, Illinois 6060680, 621-9621, dearborn.com. His pitch is big, stable companies that have good earnings and good dividends. You soon realize that there are big, stable companies and young, riskier upstarts. Once you send for some free information in the magazines, you will get on mailing lists and companies will send you all kinds of investment-related information. Golden Rules of Investing 2. I read a story about a hog farmer who waits until the market is bare, then goes to the S&P Outlook and looks for 10 good stocks or so that are companies in good industries that have lost money and buys them all in one shot, then forgets about the market until he hears the word bull, then cashes in a few every year or so when he hears about bullish times. Everybody's hoping for the big score, and all the little investment newsletters out there claim to have inside information on the big score, but, of course, they don't. But even still, if you do some research, find a few professional investors writing columns, etc. that you trust and learn from them, there's no reason why we can't make money by piggybacking on their knowledge. Some of the major money magazines have a reputation to uphold. They offer good info that you can use. If you're serious about investment newsletters, go to hulbertdigest.com or some other service that critiques and ranks them objectively, then go from there. In any case, do some research before you buy. There are 2 basic ways to succeed: buy stocks of things that people need like food and transportation. Buy growth stocks when the market is down and hold them as they start growing again. Find industries you believe will grow, then find the top few companies in that field. Look for good companies currently selling at low prices. Good companies in a dull, safe industry are often better than upstarts in an emerging field you know nothing about, but if you do your research well, you can get in on the ground floor of an emerging market. Find specialty companies very good at one thing. In order to succeed, you have to know about the companies you're buying the stock of. Playing the stocks is like gambling on roulette, except that you have over 20,000 companies to put your money on, and you get to stack the odds in your favor by educating yourself about them beforehand. It's that simple. It doesn't matter if the market is bearish or bullish. The market is not one entity, it's 20,000 plus companies. There is no universal trend throughout. As Charles Dickens said a long time ago, these are the best of times and the worst of times. That's the way it always is in life and in the market. Some companies are going through hard times while some are booming. Assume that you are investing in a company for the long term. Don't get out unless you seriously think that the company is going to crash or you have a better place to put the money where it will yield more profit. One theory of corporations asserts that corporations go through a life cycle, basically, a tough startup period, the takeoff where they grow well, then the downside where they either taper off or die as competition comes in or the product is simply stale. Just look at the computer industry. It's a textbook case. I have learned to stay out of energy and precious metals. Computers and technology, though highly profitable, could be highly volatile because of competition and paradigm changes, i.e., computer killed typewriters, satellites will eventually kill cable, cellular may kill stationary telephones, video took a big chunk out of the theater business, now DVD will replace video, and the list goes on. You got to analyze these things and look for trends. The safest stocks are money businesses like Fannie Mae and Charles Schwab. Buy these stocks, you will never lose. You can be a casual investor who checks out a few companies then invests without wasting any more time on it, or you can be one of those obsessed people who reads an investment daily every day and watches the market both on TV and on the internet. Life was not really meant for this. There's so much more to it than obsessing over money. I enjoy my life and still make money by making a few wise investments. Every now and then, I lose, but I don't get all bent out of shape about it because I don't put too much money in one place. Look at companies from a real point of view in the real world. Look for repeat business, lots of business, a recognizable brand name, past performance, and more assets than debt. Simply buy stocks based on the products you buy in daily life from established companies. Don't just rely on the numbers. Look for companies with a pattern of earnings growth over several years and reinvesting the earnings into the growth of the company. Buy stocks of stable companies that have products with repeat usage like razors, disposable diapers, cosmetics, food, etc. Buy stocks of companies that have a near-consumer monopoly like Coca-Cola, Hershey chocolates, the only newspaper in town, etc. A stock represents a company which has an identity like a person. When doing your research, examine these companies for character just like an individual. You can simplify it by studying the company reports in the Value Line Investment Survey at the library. It's all there, everything you need to know about potential investments. The bigger ones aren't necessarily better. It's the volume output in relation to size that counts. The little ones try harder. A little company that does something good increases in value dramatically, while a big company that does something good increases by only a few points. The small companies that really take off are the biggest aces in the investment world. The trick is to find them. Big conglomerates that own several corporations generally aren't all that profitable because they're too big to be efficient. Look for companies that buy their own stocks in the open market. Pick the leaders in any stock group. The economy is not necessarily correlated with the stock market. The stock market is an independent animal in a world of its own. In much the same way, many corporations are not related to the economy and some even thrive in down times. Everybody has to eat all the time, so the basic food companies are always stable. When times are tough, people hold on to their things longer and get them repaired, so service companies generally see more business. If you're interested in the overall state of the economy, pay attention to the federal government's monthly statistics in such areas as unemployment rate, consumer price index, retail sales, business inventories, housing starts, index of industrial production and gross domestic product. You can get these figures from various sources in the media, through the Federal Reserve Board, FRB.gov, or census.gov. All the big winners show major percentage increases in the current quarterly earnings per share over the previous year. Investors Business Daily and the Wall Street Journal show these figures. Also check out a company's annual earnings per share for the past 5 years to see how it's grown. Signs of a good stock are: a past upward trend, Steadily growing earnings. Good earnings. Good Standard & Poor's rating. At least 10 million shares outstanding. It hasn't been discovered by the mainstream yet, meaning that it hasn't been ransacked and prices run up. Look at the company's turnover ratio, annual sales divided by the inventory on hand, and compare it with other companies. A high turnover ratio shows that it's moving product quickly. Companies with low stock values at under $20 generally increase more dramatically than higher priced stocks. People traditionally buy very cheap stocks and go for bargains rather than going for the real hot stocks. Look for the new high in price list in Investors Business Daily. This is a good indicator of a company about to break loose. If it's in this list for several days straight, it's probably a winner. If it's in the new low in price list, it's a good stock to drop quickly. No matter how intelligent you are, a certain element of the market is luck. If you want to win, you have to take risks. Relative price strength is a comparison of a stock's price exchange over 12 months compared to all other stocks. It is ranked from 1 to 99, 99 meaning that it has outperformed 99% of all other stocks. A relative price strength of less than 70 is weak, greater than 80 is good. If relative price strength has been decreasing for several months, beware. Do the stocks you are interested in have institutional sponsorship? Like, do mutual funds and pension plans invest in them? Are the number of institutional investors increasing or decreasing? The stock market paradox is that people buy low because it's cheap and avoid high because it's expensive, whereas the winners are high because they're winners and the losers are low because they're losers. Check the new highs list and try to do some research on the company to see if it's into some kind of hot, new product, new management or research. If it hits a high for several days straight, buy into it and watch it for a while. Watch the volume % change of stocks traded for a company. If volume increases, a company price increases, it's probably hot. If volume increases, a company decreasing values, it's spiraling downwards. Compare the sales volume of the company over a year or so to see if it has increased significantly. Check other things like, do they have a large inventory which translates to poor sales and lower prices for the goods? Do they have a lot of people owing them money in the accounts receivable section? All these questions give clues as to the most relevant question of all: how well is the company managed? Don't sell on rumor. Try not to follow the crowd when they're going crazy. Be more relaxed. Step back, analyze it before you make a move. The market will always fluctuate up and down. Don't go in or get out too soon. Wait to sell until you feel the stock market is peaking. Don't buy until rock bottom is happening. Golden Rules of Investing 3. I remember cursing myself when the stock market lost big a while ago, listening to all the doom and gloomers saying that Russia and Japan were screwed and the world was heading into a global depression, contemplating for a moment to pull out, play it safe and stick with bank CDs at 5%, but I still hung tight with my stocks because deep in my soul, I have come to know what is now the rock bottom line golden rule of the stock market: no matter what happens, the stock market always eventually goes up. This is the way it's been throughout history. It always ends up going up. Don't expect stocks and stock funds to go up all the time. The market is dependent on a sheeple effect, and if investors sense insecurity, they panic like a herd and cause plummeting stock prices. Be ready for losses. You can't control it. It's part of the game for investing in the stock market. If you can't handle losing money, keep it in a safe bond fund or a savings bond, or buy a rental property and rent it out. Learn from financial planners and the like, but ultimately trust only yourself. They will always be rosy, because if they're not, nobody will buy. Monitor your investments regularly. Mistakes or bad moves are normal. Just have the sense to know how to fix them rather than simply wallowing in self-pity. If the stress is too much, invest in a safe bond, life government inflation indexed bonds, savingsbonds.gov. Pick the best companies in the best industries. Make a will so people know where your investments are. Just because you're doing great today, anything could happen. Always save for a rainy day. Never spend foolishly and frivolously. Sell off what you don't need, like a boat, cottage, etc. Get a second job or start a part-time business. If you're a shopaholic or use shopping to give you an emotional boost, get over it. Life is about spirit, not about things. For a small timer, rather than bothering with the stock market, buy a duplex or two in a nice neighborhood and live off the rents while the property values go up. Do what you intuitively feel is right. If you think the market is going to burst, get out. Better safe than sorry. Don't rely on so-called tips and insider info without researching them first. Hot stocks and funds have a way of lagging once they're hyped in the media. If it's on the cover of Money magazine as the latest hot stock, it will oversell, then the value will go down. Don't ignore all the fees and commissions that come with a purchase of a financial instrument. It might make what looks like a good investment a bad one. It's good to diversify, but at the same time, keep it simple. Don't have too many accounts or more than 20 different stocks or funds. 20 is plenty to diversify across all sectors and investment types. Change both when your stocks change and when your life situation changes. When there is a crisis, stop before you sell. Use your head rather than your emotions in investment decisions. Never forget that there is always risk in stocks and funds. Everything is always changing in the investment realm. You have to spend some time studying it constantly. If a stock goes up a lot, don't wait. Sell at least half of it. Too much trading wastes money on commission fees. Don't forget capital gains taxes.